If you've spent time on the nation's highways, you've undoubtedly seen one of their trucks. J.B. Hunt Transport Services is one of North America's largest transportation logistics companies. They report on the 16th, and we're going to talk about it today on Open Interest. Hello everybody, I'm Mike Coe. Welcome to Open Mic. Lowell, Arkansas-based J.B. Hunt provides intermodal, combining rail and truck transport, third-party logistics, traditional full-load trucking services, and final mile delivering goods directly to consumers' homes, among other services. The freight and shipping industry is closely watched as a barometer of the economy's health. The volume of goods transported reflects the demand for products across various sectors. Higher freight volumes typically indicate solid economic activity as manufacturers, retailers, and other businesses ship more products to meet consumer and industrial demand. Increases in revenue and profit margins suggest that they have pricing power, indicative of robust business activity and efficient operations. Declines, conversely, signal economic slowdowns or increased competition and cost pressures. And unfortunately, this has been the case for J.B. Hunt lately. Revenues for the most recently reported quarter were down 8.8% versus the prior year, while earnings fell 34%. Going into the most recently reported quarter, the price action wasn't fantastic, but an earnings miss and gap lower formed the death cross. A review of an array of technical indicators is, at best, mixed as we talk about this right now. And these results are consistent with the generally weak state of the real economy that we highlighted earlier this week when we talked about Fastenal on Monday. So analysts forecast that full year 2024 earnings will be lower than the prior year, even before adjusting for inflation. There is a bright side, though. Where Fastenal is trading at a material premium to the S&P 500 overall, J.B. Hunt is actually trading at a slight discount. A discount that grows if the $8.40 in earnings per share that is the mean of analyst estimates for fiscal year 2025, and earnings which would represent 8% year-on-year revenue growth, proves accurate. And while I'm not prepared to call for a stellar quarter this time around, economic pressures generally don't resolve that quickly. Much of the near-term damage may be done. And with that in mind, I'm inclined to adopt a strategy similar to the one that we talked about for Fastenal, but with a more bullish directional bias. So with that, what I'm hoping we can do here is actually take a look at a couple graphics that I have here, which might help sort of illustrate the point. The things that I was talking about, first of all, we have a slide we can see here, basically what's been happening on the revenue side. The yellow line is sort of that's each quarter's revenue results. I just introduced a little bit of a smoothing mechanism, that blue line, so we can sort of get some sense of the general trend. I also have the net income, the EPS per share, so we can see this is following a similar track as you would expect. Now, one quick point I would make is that as revenues decline, it's not uncommon to see net income fall as much or more. You have fixed costs, that's part of the problem. And also you could see compressing margins, that's a function of pricing, which we're going to get to. We can also just take a quick peek. So this is this is obviously going to mirror the net income to a degree. So of course the principal distinction that you're going to see when you're looking at earnings per share versus net income for the business is the effect of additional share issuance or buybacks, that sort of thing. So an important thing to think about for me is the business actually growing or shrinking in this case? And what's going on with the earnings per share? Because it is possible sometimes to have flatlining net income or even slightly declining net income, but growing earnings per share. How is that accomplished? Companies can do buybacks, and then essentially, so every share is going to represent an ever-growing portion of the net income, and so EPS can actually follow a trajectory. And so for those reasons, I kind of like to look at both visually. Obviously, if you're following what the buyback situation is, that's fine. You'll have a sense of it too. Here's EBITDA, and you know what? I kind of regret having thrown this chart in, I have to say. It was only after I put it in that I thought, oh, why am I doing that anyway? Because I have mentioned before, I think if, other than free cash flow, which I also take a look at, EBITDA, it just became a habit for everybody to talk about earnings before interest, taxes, depreciation, and amortization. But the fact of the matter is we really shouldn't be ignoring depreciation or amortization. So earnings before interest and taxes is probably even, I'm going to, hold me to it, but I'm going to try to make sure that those are the numbers that I highlight when I create these graphics. And here, of course, we're looking at free cash flow. Now, as we look at all of those numbers, and then actually we also look at so I'm just going to quickly pull it up on my Bloomberg so we can see this here as well. You take a look at the price action, you look at the chart, and it doesn't look great. And so you might say to yourself, well, why might one start to think that things could potentially turn around? I'm going to get to that. So we can see here that the company formed that death cross a while back, and that was when they had an earnings miss earlier. And as we can see, it's also below the 150-day moving average. The trend generally at the moment looks like we're heading lower. So why would I begin to start thinking about whether or not there might be an opportunity here to play this one from the long side in the face of all of these things which aren't so positive? And the answer to that is going to be found when we take a look at the next chart that I had. And that next chart that I have after EBITDA, I think, or after free cash flow, I think it's, there we go, yeah. So this one, what are we looking at here? So this chart right here, what this represents is various trucking rates. And what we really want to see, the only thing I think that's going to start to create some measure of support is to start seeing rates start to flatten out or turn higher. And what you'll notice is that the price of the stock has recently just been in a steady downtrend. But what we can see is that the rates recently on freight rates have actually ticked a little bit higher. And some of this uptick that we have seen has taken place during the quarter that they are about to report. By the way, I should mention one other thing, which is that their new CEO took over on on July 1st. So that's something else to think about as well. So we've got, sort of, I'm not going to say fresh management per se, but you would expect that this is somebody who's going to want to try to kick things off with a bang. This guy's Shelley Simpson. He started on July 1st. So it's sort of the fact, number one, that we had gotten to a point where freight rates had sort of essentially reached their lows for the last 5 years. And it looks like they've kind of bottomed out and gone higher. And so from my perspective, if I want something that's going to turn the stock around, this would have to be it. So all of that downtrend, the downtrend in revenues, the downtrend in net income, the downtrend in free cash flow, the fact that margins had been tightening, all of those were a function of both rates, of course, and it's basically price times quantity if you think about what their business is. And when you start to see an uptick in pricing, that's a positive. Like I said, am I expecting rates to go back to what we saw in 2021? No. 2021 was an extraordinary year. We were coming off of real supply chain and logistics problems that were well documented coming out of the pandemic. We saw a massive freight inflation. You can see it on this chart. But, I think we are seeing some positive trends in the recent history here, and I think that's a potential positive. So one other quick thing to think about, the freight rates, of course, don't impact J.B. Hunt exclusively. So I also happen to have some of their peers in a table, so I apologize, there's a lot on here. I realize that. I don't know whether you all can see my cursor, or if when you're looking at the cursor, it's just, so apparently not. Otherwise, I would just try to point these things out. But I'm going to just give you a general way to look at this table so you can kind of give some thought to it. So in the top center, when you see that orange diamond, that essentially represents the 5-year average turn for that given metric. So the top row is the forward earnings estimates, and basically you can see where that orange diamond is. The stock would be, if it was priced at its historical average forward PE, the stock would be 210.45. It closed today at essentially 160 in round numbers. EV to EBITDA, like I said, I'd rather EV/EBIT, which we're going to get to next. But based on that historical multiple, the stock would be trading around 183. EV to EBIT, 282, which seems obviously pretty ambitious from here. There's a couple metrics here where it's not quite as compelling. So for example, we can see that on its enterprise value to revenues or price to book value, it's fairly close to its historical average. JB Hunt, by the way, also trades at a little bit of a premium to some of their comps, but I think and the reason I'm talking about JB Hunt rather than a Warner, rather than a Knight Swift, actually I had lunch very near here today down in Greenwich, Connecticut, and actually it was Knight Swift trucks that I was seeing the most of on 95. The reason that we're talking about JB Hunt today is not simply because I happen to think JB Hunt is best of breed or anything like that. I do think it's well managed within their space. They're trying increasingly to move to an asset-light model. I think that's kind of a buzzword for almost every business. If you talk about the home builders, they're trying to run an asset-light model. Everybody's trying to do a business where they don't have to make a significant investment, but that's basically the idea. So what are the potential trades that one could make? So first of all, the implied move, the one-day implied move on the 16th for JB Hunt is, as of today's closing price, is about 4.4%, which is higher than the historical average over the course of the last 44 reported quarters, which is actually closer to 3%. Why is it higher? Well, certainly a good reason is that within the last 8 reported quarters, we had 2 meaningful disappointments, including Q1 2024, the stock fell 8%, and Q3 23. Similarly, the stock fell about 8% on that earnings. So one of the things you will see, sometimes there's a very good functional reason for this. You could just have changes in the capital structure of a business, and so as a function of that, the volatility of the equity may increase or decrease depending on how much net debt or net cash a company has on its balance sheet, that sort of thing. But the fact is that if you see bigger moves more recently, then you might expect to see that implied in the options price as well. Also bearing in mind that, like I said, the fundamental backstory, while pricing has certainly improved, that does not necessarily mean that they're completely out of the woods. So what are some trades that one could contemplate? Well, the first trade one could contemplate would be a strangle swap. Now, a strangle swap is a form of a calendar spread where you sell, or if you're long the strangle swap, I should say, where you're selling a nearer dated strangle and using the proceeds to help finance the purchase of a longer dated one. Much like we talked about in Fastenal, you can take a directional view with something like this where you could just trade an upside call spread where you have a target price. So let's say that was 165. You could trade a November-July 165 call spread. If you think that the move of about 4% or so is appropriate. So the one I was looking at, for what it's worth, was I think the 150, it might have been the 150, 165. I think that's what I've got over here. This is the kind of payoff profile you're going to get. So basically, you're going to get peak profits if the stock runs to the higher strike calls, so the call spread. You will still see good profits if it runs to the strike of the puts. So this next chart just sort of gives you a sense of where that would be with respect to the recent price action in the stock. So you're going to sort of get that region there in green. Now, the truth is that between now and July expiration, you see a lot of red on that. But the green boundaries are essentially the implied move. We're going to expect that there's about a 60% probability of profit on a trade like this through the end of next week, which is the expiration for the front month strangle, that you would be selling in this case. However, and by the way, this, as you look at this chart, you're looking at a chart that's a year, so we're only going forward a week, so you can see that obviously the price has materially differed from where it is right now, but an important thing to think about is how much can the stock price move over the course of 1 week. So better than 50-50 probability of profit, but as you can see, if it really did something wild, which I do not expect, by the way, but if it went to those prior highs, you're looking at greater losses. So you have a better probability of profit, but the amount that you're expecting to make in the more likely case is potentially less than the amount that you could potentially lose in the less likely adverse scenario. Important things to think about. Why do I mention this? Because if this chart doesn't appeal to you, there are alternatives. And what I did here was buy the November 160 calls, which is effectively the at-the-money call option, and then sell that 150. So selling that same front month strangle, but only purchasing one leg. That's the upside one. It's just slightly out of the money 160 call. So what you're really doing now is you're selling a downside put, and you are trading a diagonal call spread. The November 160, essentially now the at-the-money calls. The stock actually was up almost 3% today. So when I was looking at this earlier, the stock wasn't up quite as much. So, for example, you can see here in this chart that we're showing on the screen right now, at the time that I was looking at this, the stock was 157.68. Stock was up just under 1.4%. Stock closed just under 160, up well over $4. Which, by the way, is another interesting thing. So I like to see that kind of price action. XLI, the ETF that tracks industrials, transports are a subset. That was up, I think, 80, 90 basis points. So materially outperforming industrials overall. Stock obviously catching a good bid here. So this is another strategy that you might want to contemplate if you're kind of on board with the fundamental case that I just outlined here, but you're uncomfortable with the amount of risk that you'd be taking, particularly the upside, right? So we've had, within the last 4 reported quarters, 2 of them, the stock has gapped down more than 8%. Maybe you're thinking, I don't want to have any kind of naked short upside exposure, or at least nothing close to that. So if you're thinking if it went down 8%, it has to go up 10 just to catch back up, and you're thinking, okay, if it gaps back, I don't want to have any exposure there, then this second strategy might be more appealing. I don't know if we can flip back to that prior one, because there's just one quick point I want to make here. One of the things you're going to notice is that this strategy, the strangle swap strategy, is a strategy that has decent amounts of profitability. Well, good if it goes higher, but not bad if it goes a little bit lower. So we're talking about that 4 or 5% price range. Whereas the subsequent strategy I was talking about, it has more upside skew. As you can see, basically your profits dwindle off below spot, and then ultimately you just see losses to the downside. Why is that? It's because you're naked short a put in this case, and the downside is that you are put the stock at that 150 price. If that happened, you actually have an interesting situation on your hands, and you're going to probably want to sell some premium against it. Why do I say this? Because it's not exactly a Texas hedge, but you're going to own that longer dated upside call, and you're going to potentially be long the stock. So size this thing accordingly. If you're going to do this strangle swap, and you're going to allocate a certain percentage of your portfolio to it, that's one thing. If you were going to do this trade, in terms of the contract sizing, you probably want to do about half of it. And the reason is because if it goes against you, you have that naked short put exposure, which the strangle swap doesn't offer. You could have losses to the downside in the strangle swap, but the fact is you have that longer dated put as protection against the shorter dated one you sold. So your max risk is going to be limited in that case to the amount of premium that you spent. Not so here. Here you're actually taking the risk of actually owning the stock. In this case, your risk is that you're going to own the stock at 150, which is $9.78 lower than today's closing price. Okay, so with that, I think there's something else I need to boot up here. I don't know if it's on this machine. So in case anybody has any questions, which I should have loaded this up. Okay, so here we go. But FinWest, good morning, Mike. Sorry I missed your last 3 live streams, but caught up via the archives. Well, thank you for doing that. That takes some patience. Well, you know the nice thing about that? You can speed it up. You can watch me at 2 times speed or whatever you can jack the speed up to. So that's good. Wesley Yee says, SPX relative strength is 80. VIX also rose slightly, but probably insignificant as your earlier comment about a rising VIX and a rising market. Oh, okay, yeah. So for anybody who's joining this and was not a part of the earlier live stream where I discussed this issue specifically, I've made a couple comments about this year. I've said it more than once. This year, to me, based on my own history in the markets, feels probably most like 1999 as anything. I know some of you have heard me say that before. I think I said it on the last live stream. 99, of course, scares a lot of people because people associate it with the tech bubble and the subsequent tech wreck. There was a lot of questions about equity valuations in 99. Actually, questions about equity valuations started 3 years earlier. It was in 1996, if memory serves me correctly, that Greenspan, who was then the Federal Reserve chairman, spoke of irrational exuberance. And the market rolled and churned a little bit based on that, and then continued inexorably skyward for the next several years. And so when people think about 99, they kind of think of that as the precursor to a disastrous crash for the NASDAQ, which is true. It fell 80%. But if you were looking at it in mid-99, it still had a ways to go. The market rallied all the way through March of 2000, and that's when it finally kind of gave up the ghost. And what Wesley is referring to here is that one of the observations I made at the time, and I've discussed this a few times since as well, is that as the market reached that crescendo, I'm speaking like Biden now, crescendo, in March of 2020, one of the things that we saw was that the typical pattern of rising markets and lower volatility, that relationship started to break down. We started to see rising prices, but then we also started to see rising volatility. First in a handful of single stocks, and then more generally in in the market. And so it is something to pay attention to, for sure, is the VIX rising and the SPX rising. Those are things that we might be a little bit concerned about. So the VIX today, up 34.34, I should say, is probably the easier. So let's just pull up a chart of that. But what we can see is that it is still epically low, or certainly epically low when we look at it in the historical context of the last few few years, certainly since the pandemic. So we're not quite at a level where vol is breaking out. I wouldn't normally think of 34 bips as really a big change in the VIX to think about, but it is something to keep your eye on. If you start to see the market hitting new highs and vol is rising at the same time, that's something that I typically find troubling. And what is also interesting is that I happened to see a tweet, was it today? May have been yesterday, from Larry McMillan. Now, I don't know Larry personally. I don't know that we've ever met, but I certainly know of Larry McMillan, read a couple of his books. I think he knows who I am also, but he had sent out a tweet, and one of the things he had highlighted was the fact that, we did see some breadth in the market and still very low vols, which is generally, all else equal, that's supportive that a bull market's going to continue. So when you start to see that narrow and you start to see volatility tick up, those are things to keep an eye on as potential turning points. Also, I think on Monday I may have spoken about Marko Kolanovic. I'm not sure if I did or not. He was the chief market strategist, global market strategist at JP Morgan. One of the very last things he did before he left the firm recently was say that he thought that the market could pull back more than 20% by the end of the year. Let's caveat this very quickly by saying that he was the most bearish of the big market strategists on the street. I think his year-end price target was in the low 4,000s. So the most bullish ones, like Bank of America and so on, have been raising their price targets. I think we've got one up to 5,600 or so. That might be the high price target, and I'm not sure, and we're already above that. So, these guys are all playing catch up. But it is interesting that, he saw that as a potential vulnerability. So we have that. Okay. FinWest, I'm looking forward to another earnings season, starting with short puts in JP Morgan. JP Morgan. So interestingly, JP Morgan, and we talked about this on Monday's show, typically doesn't move much on earnings, which sets up very well for short premium trades where you're looking to collect premium. The problem is that you're not going to collect a whole lot of it just because the market's not anticipating big moves. Selling cash-covered puts, which is a strategy I generally like, or doing buy rights, another strategy I generally like. These are kissing cousins. They're synthetically equivalent to one another. I don't typically like doing buy rights or covered calls through earnings because I often feel like that's when you could get a real potential reset in a stock price. And I just don't like the way the risk-reward sets up. So for example, in a name like Nike going into earnings could sell some premium, but just simply doing a buy right, not that appealing. You want to give yourself a little bit of a downside buffer. We didn't give ourselves enough of a downside buffer this last time. And Nike just demonstrates the risk here. You can have these big price resets. FedEx has done it. These things happen. So sometimes it's better not to be short premium through earnings, but in JP Morgan's case, it doesn't really move much. I don't think there's going to be a lot of surprises there. Okay, here we go. So here's another financial. Mike, I have Goldman, July 19th, July 12th. Oh, the weekly, 475 call calendar. Part of July 12 short calls I bought back yesterday. General question, when to close when stock goes above the short strike? 60 delta is usually where I start to acknowledge that maybe I have the directional part of that wrong. And if it's 60 delta, that means that there's, you're basically, you're in the money, right? So if you sell an option and the delta goes above 50 and now gets up to 60, you're now dealing with a simple way to think about it is 60% chance or greater that you're going to get assigned on the short side. And most of the time when we sell options, you can if you're selling cash covered puts on stocks that you want to buy, or you sell covered calls on stocks that you otherwise were hoping to exit at the strike price, and that's why you sold them there. That's okay, but I think more frequently people initiate short premium options trades just on the hopes of collecting the premium and not actually taking assignment. And so when you start seeing the delta creep up, what you're seeing is that the probability that you're taking assignment is going to rise. And where you set that alert, if you will, is going to be up to you. But if you think about it that way, it might sort of give you some guidance on how you would make those adjustments. Okay, so next question, MM asks, hi Mike, how do you like Morgan Stanley into earnings next week? So it seems like, so all of these banks have some businesses in common, but in many cases, individual banks have decided that they were going to focus on specific parts of the business. Many years ago, we might have thought of Morgan Stanley and Goldman Sachs essentially as being in direct competition with one another in most aspects. Morgan Stanley has won some pretty material and significant investment banking deals. Morgan was the lead on the Facebook underwriting, for example. But I would point out that more recently, in more recent times, Morgan Stanley has focused much more significantly on asset management as key to their business. And so they're going to be a little bit less sensitive to the investment banking side and to trading. Goldman Sachs gets a lot from the trading side. Why does that matter? Well, think about it this way. They get paid as a percentage of assets under management. And assets under management are in turn going to be a function of two things: net deposits and withdrawals from customer accounts, and capital appreciation or depreciation of the assets held in those accounts. Well, the market's at all-time highs, folks. I mean, not the bond portfolios, of course, but the bond portfolios have been relatively static, and equities are substantially higher. So let's just take a quick look at this and say, oh, okay, well, what does that mean for their performance? So their most recently reported quarter was through March 31st. So one way to think about it is to say, okay, well, some percentage of the total assets that they manage, so ignoring any net deposits and savings and investment that they've been getting, what has the market done since March 31st? And of course, it's higher. I mean, it has to be. The market's at all-time highs. It can only be the same or higher. So we can just put that in and say, okay, well, the S&P is up more than 7%. Now, actually, I shouldn't put July 10th in here as I take a look at this. Why? Because when they report their results, they're going to be reporting it for that quarter. So the appreciation isn't quite as significant, but it's 4% is the price change, 4.3% total return. Total return matters. People own the stocks, are receiving the dividends, are probably not spending all of it. You're probably getting net deposits. So that would mean that the equity portion, U.S. equity portion, if we just had to approximate, it's going to be up 4%. So that's going to be good. And that's quarter over quarter, by the way. That's not year on year. That's quarter over quarter. So that's good for revenues. And what we also know is that the market's up another 3% since then. So this is a tailwind. Also something to think about. Tailwinds can turn to headwinds. So if the market weakens, so I like Morgan Stanley. I like that that's the area of the business that they've elected to focus on. They seem to be good asset gatherers, and assets are generally rising. So that's a positive. Hope that helps. Okay. Mike, would you please put on a Royal Caribbean trade using a risk reversal or credit for bullish? It was 254 just last week, now 602 into earnings. That Okay, so I'm imagining there's a typo in those prices someplace. I'm guessing, yeah, you must have hit. What? So Karen, fine. Yeah, if I could just trouble you, and maybe you can follow up on that. Not 100% sure what you're referring to there on the, because those are not the prices of Royal Caribbean. It's a $163 stock. But let's work out a, well, let's just take a look at a couple things here. Okay. So, first things first. Royal Caribbean, they're going to be reporting on the 26th. So that is 16, let's see, yeah. So 16 days from today. Options market's implying about a 5% move. That's in line with their history. Actually, we talked about Royal Caribbean, now that I think about it, on a live stream maybe a couple weeks ago. The point I was making at the time was that there had been a pretty significant divergence between businesses that appealed to the upper end of their respective market versus the lower end. And I think I was just talking about the relative outperformance of Royal Caribbean versus Carnival. So Carnival is, you know, I don't go on cruises, but I understand it's, I don't know whether entry level is the right term, but you know, it's priced for, you know, it's a lower priced area. So Royal Caribbean is theoretically, therefore, less sensitive to, you know, economic pressures. So let's just take a quick peek, and I will frame a bullish trade on Royal Caribbean. And you are interested in a risk reversal or a credit. Okay. So let's take a quick peek at that. We'll start with the risk reversal. And you didn't specify what kind of a tenor you were interested in, but let's just assume for the sake of argument that you were interested in doing this trade through earnings and for earnings. So we can just take a look, and maybe we'll look at the August regular options here. A call spread risk reversal, generally the way I would employ it, I'm going to buy an at-the-money call spread and look to trade this thing for something close to even, if I can. So, oops, sorry. Good question. Good question. I was just pointing, somebody pointed out I was too busy over here. Royal Caribbean, ignore all that. Gotta double check your tickers. But again, so same thing here. Trying to get something that is close to at the money if you can. Now this one does have weeklies, so we could choose something that's a little bit more suitable in that respect, but I'm not going to. We're just gonna work with the regs for now. So you'd be buying an at-the-money call spread, selling a downside put, preferably for something close to even money. So let's see here. That one's pretty much close to even money. 155.60.70. So this one is actually slightly in the money, as you can see. You don't lose until it actually drops below that put strike, the 155s, which is down $7.67 from today's closing price-ish. So, you know, you get 5% downside buffer. And then, of course, you have $10 worth of upside. So slightly asymmetric upside in and around spot. Remember that this one is implying a move of about 4%, but that's day of only. So if you're trying to play for that one specifically, you would obviously bring the expiration in and just target that implied move. And that's an interesting way to do it, right? So you take a look at the value of the at-the-money straddle for the stock that you're looking at. Through that expiration date, that's effectively the implied move for that stock. The implied move is going to be something that you figure is going to represent, give or take, 60% of the possible outcomes. So you will probably get a, you know, you're going to be within those boundaries more often than not. It's not a huge excess probability, but there is a higher probability that it lands in that region. And so you could do that. A credit spread, quick point on, now by the way, in whether you are doing a call spread risk reversal as a bullish bet, or you are doing, say, a put credit spread, you're selling options. And when you sell options, and that's a part of how you're hoping to make your money, you don't want to go too far out in time, because you could actually push this thing out a year and you're going to get a very asymmetric risk-reward relationship. It's going to, you're going to have a lot of upside and a big buffer to the downside. But the problem is that it's going to behave a lot more like the stock in the interim, because that decay isn't going to really kick in. So you're looking out to that future date, but that's really not how your P&L is going to behave in the near term. So trades like this, I usually prefer to keep them a little bit shorter dated. So now let's just modify this thing really quickly. We'll pick a different one here and just take a look at a potential credit spread. So if you're making a bullish credit spread, what are you going to be doing? 72 days out, that's too far. August 23rd, that's fine. So you're going to be selling a downside put and then buying one that is even further out of the money and hoping to collect the difference. And what you'll observe when you do this is you'll get something like this, which is the max gain is something less than your max loss. Not surprising, because the offset to that is over here, your probability of profit's about 60%. So kind of like doing those strangle swaps, which I talked about earlier. If you're playing in that, the implied move space, much like the implied move is about a 60% probability that it's going to be that amount or less, the probability of profit for these trades is going to be very similar. So those are two potential alternatives. Something like the August 23rd 160, 150 credit spread, you're collecting 34% of the distance between the strikes on a mid-market basis for a trade like that. Call spread risk reversal, you saw that one as well. Okay. Asking the other trade, if you prefer, too late, is Netflix earnings next Thursday. Also, large run. Not sure if put credits would be best. Okay. First of all, just making sure that I'm actually sharing that with everybody. So let's just confirm what's going on with Netflix. So Netflix, they are going to be reporting on the 18th, so 2 days after JB Hunt. Options market's implying about an 8% move. Now that's interesting. 8% is a big move for most stocks. It is not a big move for Netflix. Why not? Well, Netflix dropped 9% on their most recent report. That was the Q1 24 report. They were up nearly 11% the quarter prior. 16% move, 8.4% move. Dropped about 3% April of 2023 last year, but before that, 8.5%, 13.7%, down 35%. I mean, 8% implied move. This is kind of interesting. It hasn't moved less than 8% but once since January of 2022. So that's, actually twice, I'm sorry, it was up 7.35% day after July 19th, 2022, they reported after the close, and the following day it was up 7.35%. So selling premium into, let's also take a look at what the stock's been doing lately, right? So how do I feel about this? I don't like selling, selling put credit spreads into earnings on Netflix, especially when it's implying an 8% move. You can see, actually, if you're looking at this chart, that it gapped lower the last time they reported in April, and we're higher now. So, one of the things we need to ask ourselves is, are we being appropriately compensated for the risk of providing insurance on a stock that gapped lower on their last earnings result, is now trading higher, on an up day is trading lower? Not my favorite way to do it, I have to be, I have to say. If you like Netflix, which is fine, I might be more inclined to use a debit call spread, maybe a call spread risk reversal. But the problem is, so when do I like call spread risk reversals? When do I like strangle swaps? I like them when I think, boy, that implied move is really juicy. I just have a hard time believing that the thing could move much more than that. And in Netflix's case, that's not my sense of it. No, it's had a couple, it had a move of 3%, had a move of 2% within the last several years. But most of the moves have been significantly more than that. So, my thinking is probably better off taking advantage of the fact that the options market is implying a slightly lower move and using a debit spread instead to do that. And think about it this way also. Whether you're right or wrong, you're probably going to be better off on a risk-reward basis than you would have been just playing the stock straight up. Okay. Let's see here. Okay. JB Hunt. Well, I guess that was a follow-up question because I may have accidentally had the wrong ticker in there, but I was looking at JB Hunt earlier. And so you're thinking about, okay, when do they report? So the question is, did I share this? Let me just make sure I did. Oh, did I not show the JB Hunt trade on OptionPlay? I should do that. Okay. So let me go quickly to.
You had the wrong chart.
Yeah. So let me just go to OptionPlay really quickly and put the. So I had illustrated that JB Hunt. I don't know which of the two trades you were talking about, but I'm assuming you're talking about the strangle swap. And actually creating it right here and now just probably will help illustrate the point. So again, long strangle swap, selling a strangle that is give or take the implied move, capturing earnings, and then buying a strangle swap that is longer dated and captures two earnings is my preference. The two earnings, just as a reminder, or for anybody who hasn't watched before, what happens is after a catalyst comes and goes, there's something called a vol crush. Vol comes in. It's going to be less pronounced if you're capturing those subsequent events. So what's that going to look like? Okay, so first of all, I was looking at July. Let me just put this to the mids. We're selling this. We're going to sell a call. We're going to sell a put. We're going to do it at, call it $7.50. We're not really able to. Maybe I'll just, for simplicity, because the stock's 160, I'm just going to say the 150, 160 is the front month. That's more than the implied move, but you get the point. Doesn't have $7.50 strikes, which would be closer, of course. And then I'm just going to go out to November and buy the same one. Now, by the way, you can do these as diagonals as well. Nothing wrong with that. Sometimes it actually makes sense, and sometimes you're forced to, because when you have, especially when you have weekly options, sometimes you just get more flexibility with respect to the strikes in one expiration or another. More often than not, it's going to be the weekly options that have things like dollar strikes, so you can tailor the short side much more closely. The long side, maybe you have $5 strikes or whatever. Okay, so this shape that you're going to see looks a whole lot like the one that I was showing you before. OptionPlay's probability of profit for this one, significantly greater at 81%. I feel like that's high. That doesn't That feels high to me. Probably associated with the volatility forecasting mechanism. So in OptionPlay, you actually need to make some of your, well, you don't need to, and it has some defaults, but I would probably bake in a little bit more vol crush than is probably in here by default. My guess is the probability of profit is not north of 80, but it is decidedly better than 50-50. It's better than 60% probability of profit on this trade. So I think that's the one you were talking about for JB Hunt. The other trade I was talking about, just to simplify things, what you would do to create that diagonal is you would kill the long put on the Novembers and trade the at-the-money call, and you get something that looks like that. So more downside risk because you potentially get put the stock. Yeah, that's about right. 62% probability of profit. The nice thing about this is you don't, if the stock does take off, and I'm not expecting it to really take off. Remember, you guys all saw the chart of the freight rates. Freight rates have ticked up, not taken off. So let's set our expectations accordingly. But what we can see here is that the advantage of this trade over the other one, although it has more downside risk, is that you can't really lose on an upside move. You can make less on a really big upside move, but you're not gonna lose money on an upside move. Okay, so I hope that illustration is helpful. Spicy barbecue tasty. I put the Fastenal trade on. Yeah, well, let's take a look. So this is it was a similar structure we talked about in Fastenal. There too. So the thing that's interesting is that Fastenal is just a fascinating growth story, as we talked about on Monday. Who would have thought that a hardware fastener company would exhibit long-term growth and capital appreciation similar to something like Microsoft? Probably not the first thing that would have occurred to you. But the difference is that lately it hasn't been that great. 30 times forward, look, the company has done some great things over the course of the last couple decades, but 3 to 4% top line growth, 30 times forward, that's hard for me to really get enthusiastic about that. Karen Fine, yeah, no, we saw you had, yeah, okay, so that you're just getting the update on the prices there. But yeah, it is interesting, isn't it? A lot of these companies are, the booking for the cruise companies and for Royal Caribbean, really good booking numbers. And I think we talked about how good their booking numbers were when we talked about Carnival a while back. And interestingly, now that I think about it, I know I've talked about Carnival twice because I spoke about it when I was just talking about the dichotomy between those businesses that appeal to the upper end, and in some cases, the very upper end. So, in the apparel, I think I was using the example of that sort of hierarchy of fashion. Things like Prada and stuff that are at the very high end versus somewhat aspirational brands versus sort of mass market luxury and things like that. We did talk about that. But then I also pointed out that the bookings in a subsequent live stream, that the bookings for Carnival were actually surprisingly strong. Stronger than you might have thought, given that their demographic. Anyway. Okay. Joseph Kamen, please pause a few seconds showing the trade so we can write it down. Yes. Okay, good tip. Sometimes I drone on too long, but other times maybe I'm zipping through things too quickly. I will say this though, and that is that these are recorded, luckily. So as long as we make the graphic, the illustration good enough, you can always just scroll through and pause it right there, hopefully be able to see it. But I will try to make sure that everybody has enough time. Okay. So we have a mechanism to share a link. Unfortunately, while Mike is traveling, we are unable to do that. And of course, he needs to remember to click the button. Yes, so production staff reminding me that they have built a lot of things that make it easier for you guys, the viewers, but I have to remember to do them or understand how to do them. But right now, unfortunately, I'm on the road, open mic on the open road, so I'm not really able to do that. Okay, so I don't know if anybody else has any questions. I ask because I have once again chewed up about an hour of your time. Let's recap a little bit of what we've been talking about today, rather than just being so abrupt at cutting things off. And the reason I bring this up is because there's a real habit I have found from, I'm a pundit, right? So I'm on CNBC a lot, and there's a lot of other folks that are too. We have a habit to talk about things like multiples, price to earnings multiples, price to book, price to tangible book. We're talking about financials, EV, EBITDA, price to free cash flow, price to sales. And just to take a look at those numbers, I am guilty of this when I talk about these things without actually delving into what drives those numbers. Sometimes we don't have good insights on that. Sometimes we do. Retail sales data, there is a lot of alternative data with respect to credit card transactions. We can see inventories on dealer lots. Sometimes we kind of have to, you can never see around the corner, but maybe if you see some smoke blowing from around the corner, you can guess that maybe if you did look, you'd see a fire. Or if you smell it and it smells like very tasty honey roasted nuts, maybe there's something good lurking around the corner, I don't know. But my point is that people often look at things like Baltic shipping rates, and sometimes that gets a mention on CNBC, but things like freight rates are, those are a matter of public record. And I feel like we're shirking our responsibilities when we just talk about trailing results and historical multiples without reminding ourselves and everybody else what drives these things. So, like I said, most of the data we've had on the manufacturing side has been, I'm not going to say soft, it's not recessionary. Some of the ISM data was definitely contractionary, that wasn't great. But look at things like freight rates and see if it's catching a bit, or at least firming up or stopping going down. JB Hunt has continued to go down. We're looking 3 months back when we look at their operating results, but freight rates have stabilized a bit. And it's not trading at a premium to its historical multiple, and it's not trading at a premium to the market. So that's the reason I would start considering trades like these. So that's all I've got for you today. I will hopefully be back next Monday at 4:15 Eastern with another trade idea, probably earnings related, maybe an economic announcement for us to talk about and to take your questions. I say hopefully because, as you know, Open Mic is on the open road and I may actually be traveling next Monday. I don't know yet, but there's a possibility that I may be. And if so, we may just push this until Tuesday because I'm 90% sure I'm going to be available for that. But in the meantime, those of you who did tune in for this one, as always, I thank you very much for watching, your time, your attention, and your questions. Really appreciate those. Like, subscribe, tell your friends, comment, and I will see you in the next one. Thanks for watching.